Good afternoon, everybody. I hope everybody is doing well. Thank you very much for registering for our webinar today, which we're hosting in partnership with Moody's, one of the premier providers of information for transfer pricing purposes. I'll just be introducing today. I won't be talking, although you might see me coming back in the end towards the Q&A. It's good to have all of you on today's webinar. As you may know, we regularly organize these types of webinars and seminars. Do feel free, for those of you who have not connected to us yet, to follow us on LinkedIn, to follow our YouTube channel as well. We'll be recording today's session and we will be posting it as well on our YouTube channel, as well as posting a link to the recording on our social media and included in our newsletter. If today what we're going to be covering is obviously a very exciting development in the UAE, which has already started a couple of years ago in the GCC transfer pricing. For that, we are today in the presence of Liam, who's going to be presenting on our end, and we've got Paul as well on Moody's. And I think rather than bringing a too theoretical overview of the specific legislative provisions, what we've tried to do is keep it interactive, number one, by polling a lot of the registrants. So we've got quite some feedback from a lot of you, so thank you for that. And in addition to that, we've also wanted to share some practical insights as to how TP has evolved in the GCC region, which gives us a bit of an insight as to how this is going to be evolving further, and also giving you a couple of practical steps as well in terms of how to address the challenges that lie ahead. When we look at the contents of today's webinar, I'll be doing the introduction, and once the introduction is over, I'll be handing over to Liam and Paul. We're going to take you all the way to the end. We will have time for Q&A near the end, so you can leave some of your questions in the chat box, but I would say hold your fire a bit until the end. I know that a lot of you have a lot of questions on this, and it's obviously a very important matter. We will try and make sure to make ourselves available for questions after the webinar, but equally so, if you have any questions and you'd like to get in touch afterwards, you have our contact details, and if not, just email Liam at rfr.tax, Thomas at rfr.tax, or get in touch with Paul at Moody's. Looking at the structure for today, so I'll be doing the introduction. We're going to be looking at a couple of results from polls that we did, both online and with the registrants. We're going to be reviewing some of the provisions in the UAE corporate income tax legislation, which are relevant for transfer pricing purposes, and that might be more provisions that you might expect. We'll take you also a bit through the evolution of transfer pricing in the GCC. We've got a neighboring country, Saudi Arabia, that has much more extensive transfer pricing guidelines already since 2019, and it's a good example to look at. You know, when it rains in Saudi, it drizzles in Dubai. I'm not sure if that expression can be fully used here as well or not, but it is the guiding example in the region. We'll discuss a couple of steps around implementation and preparation for taxpayers going forward, take a couple of questions that we've already received beforehand, and then reflect on a couple of next steps. I said I won't be talking much, but I will do the intro, and once the intro is done, it's over to Liam and Paul. For those of you who joined late, thank you very much for joining. You have not missed much except for my introduction. I'll be handing over to Liam and Paul in a second, who will take you through the transfer pricing provisions in the UAE corporate income tax law, and more importantly, practical tips as to how to cope with them and how to comply with them. Taking a step back and providing the context again of why we are organizing this this webinar. As most of you would know by now, last year, 31st of Jan, the Ministry of Finance announced the introduction of UAE corporate income tax with effect from June 2023. So that's in less than 6 weeks. Subsequently, in April of last year, it published a public consultation document. That public consultation document was essentially the blueprint for UAE corporate income tax. It already outlined a couple of principles from a transfer pricing point of view. And as we've seen, the corporate income tax law, which was then published on the 9th of December 2022, did not deviate much from the public consultation document. So it was a blueprint, and it was the plan that was followed closely for the purposes of the drafting and design of the corporate income tax law. I think the important thing on the legislation for the purposes of today's webinar is that there's direct references to what is the arm's length principle, and more importantly also to the OECD transfer pricing guidelines, which means that hopefully we will expect a regime which is simply going to follow the OECD's transfer pricing guidelines, much like Ireland does. And I think for that purpose, we're in excellent hands to hand over to Liam and Paul to take you through the rest of the slides. I'll be back near the end. Thank you very much.
Yeah, thank you very much, Thomas. And thanks again, everybody, for attending. Hope you all had a lovely Eid break. Thank you as well to our friend Paul for joining the webinar. I guess just a very brief introduction of myself. Like Thomas mentioned, I hail from the land of Ireland. So previously worked there as a senior manager in transfer pricing for 7 years with a member of the Big Four. Interestingly enough as well, Ireland, you know, they only introduced kind of fully fledged transfer pricing rules as of 2020. So do have some experience with that implementation and kind of the necessary steps for preparation. Paul, I'm not sure if you want to give yourself a brief introduction before we kick in.
Sure, thanks, Liam. So I've spent most of my career in transfer pricing, so that's 20 odd years. I originate from the UK, and I have worked in the Big Four. I've worked in industry, and I've had a spell in a tax authority, and so I've got a pretty broad experience of transfer pricing globally. And so whenever there is, you know, the introduction of transfer pricing in a new country, there's a lot we can leverage from knowledge and experience from experiences elsewhere where this has been introduced. So hopefully I can help feed that into our discussion today.
Absolutely. So yeah, I guess to kick us off really, and it's worth discussing the overarching concept which kind of dictates transfer pricing, which is indeed the arm's length principle. It's the international standard endorsed by the OECD as well as, you know, the United Nations and other bodies in relation to how intercompany transactions should be conducted. And really, as it says on the slide, that it comes from Article 9 of the OECD Model Tax Convention. And to kind of simplify the extract that we have there, it's really the intention is to ensure that related party transactions are conducted in a manner akin or similar to those transactions that, as if they would be conducted through independent or by independent persons. So when we look at it, you know, being part of a group should not influence any decisions in terms of pricing. Really, when we look at this, and I know myself and Paul have had a number of discussions on this, one of the key things is that a lot of multinationals will engage in intercompany transactions and they will consider it to be arm's length. But the real question, I suppose, is kind of how you go about proving that. And really, there's a number of different steps which we'll look to take you through during this webinar.
Yeah, so Liam, I think the only thing I would sort of add to that is that, as you were saying, you know, the vast majority of multinational enterprises, they intend to and they believe that they are pricing transactions at arm's length. And the challenge is then proving that to tax authorities. And that isn't quite as simple as it might sound, because a lot of these transactions don't necessarily occur between two third parties. And sometimes there is, you know, a lack of support, a lack of data, a lack of specific, exact transactions that you can use to benchmark, to prove that your transaction is arm's length. And where the world has moved on in recent years in terms of transfer pricing, and when I started, you know, 20 years ago, it was almost like a maths exam. So you got half the marks for getting the right answer, so getting the pricing right, and half a mark for showing your working, so documenting. What's changed over recent years is there is now a key step before all of this. And that step is proving that the transaction that you are pricing is commercial or arm's length. I.e., you know, would that transaction ever occur between two third parties? Because if you cannot support that that is sort of an economic transaction that the two parties would enter into, is almost pointless going down the pricing route, because you're effectively pricing a unicorn. So it's a very, very simple concept, but one that is fraught with a lot of complexities when it comes to trying to prove this to tax authorities.
Couldn't agree more. Yeah. So I guess before we kind of kick off, we might just take a look at the pre-polling questions and the results of those that we shared prior to the webinar. So really, we asked 3 questions really in advance of this webinar. Do you currently have a UAE local file in place? What is the most challenging aspect of TP compliance that you face? And then additionally, whether anyone has been subject to audit in Gulf or the MENA region to date. And when we look at the results, if we start with the local file, I think it's been a pretty resounding no. So 92% of people said that they do not currently have a local file in place. And I guess the first thing that I'd say in that regard is that that's totally okay. You know, that's fine. Up to this point, there was no requirement to have a local file for UAE transfer pricing purposes. Additionally, we'll get into a little bit more detail around the documentation requirements when we go through the UAE TP legislation. But in short, there's no filing requirement along with the corporation tax return. It's a prepare and retain kind of approach that the UAE are adopting, which is very common in practice. So it would be required to retain the local file, have it prepared, and only provide it within 30 days upon request. So really, there's also a lot of time to go. Really, the first time that we would expect that a local file should be due or requested by the FTA would indeed probably be somewhat aligned to the corporation tax return. So that would be 9 months after the accounting year end. So for companies with a 31 December year end, your first year that you'd be within scope of the rules would be January, starting January 24. And the local file would only ever be requested by September 25. So there's still some time there. And then for the 8% that have the local file in place, top marks, that's a really good job that you have it in place already. I guess the only thing would just be to perhaps look to, if it's prepared centrally by kind of like group tax, you might just take a look at it to make sure, I guess, that the facts are aligned. And indeed, that the kind of functional analysis and things of that nature is not overly generic, that it is specifically addressing the activities of the UAE entity.
Yeah, and just on that, Liam, I think recent experience from my time in practice and understanding where tax authorities are at, they're experiencing a lot of frustration around what's actually in the local file. And it's not necessarily the sort of depth of detail. It's more actually whether or not they can rely on the facts that are supposedly in that document. And it's a real level of frustration with tax authorities because it leads to trust. If they can't trust what's in the document, then when they conduct their audit activity, they have to start from square one, establishing what the facts are. And this can ultimately lead to very elongated and complicated and painful audit experiences. So yeah, it's almost good that we don't start with a generic document that doesn't reflect the true facts on the ground. There is a bit of time here to prepare that, but it's probably out of the documents the key one that people need to get right from day one.
Yeah, absolutely agreed. And then if we move on to the next question, I suppose the most challenging aspect of TP compliance. So a little bit more of a mixed bag in terms of the results here. So 64% said it was uncertainty on approach to audits that will be undertaken by the tax authority. And then 22% said the lack of regional comparables, with 14% the lack of internal data available. So I guess just addressing the big one, the elephant in the room in terms of the uncertainty on approach. Excuse me. Unfortunately, we're not crystal ball gazers. We won't know exactly in terms of the approach that the FTA will take, but when based on my own experience in Ireland, which, as I mentioned before, only introduced kind of full-fledged TP rules recently, they really took a kind of slow build approach, right? So as they build up their own internal capabilities, get their staffing together and really get a grip themselves on the technical complexities that is involved with transfer pricing and transfer pricing audits, it's really just to make sure that you're taking the bare minimum, right? So that you have your local file prepared and in place up to a reasonable standard, and that you're, not doing anything completely off the wall in terms of approach to transfer pricing, things of that nature. Just really, as the FTA builds up their approach, I guess we could say that it's likely that, just get the basics right at the outset, and then it must be somewhat of a wait and see.
Yeah, I think the only thing I would add to that, Liam, is just when people are pulling together documentation to support their positions from year one, it's often helpful to sort of step back and think about how this might be viewed from a tax authority's point of view. And what I mean by that is you might have 5 or 6 transactions that you're trying to support, and it's very possible that you can go through a process and support each and every one of them. But when you have a look at the overall results of the entity in UAE or the business overall, that there might be a bit of a question mark. There might be some losses, there might be poor profitability in one year versus another year. You might be out of step with your industry competitors, or you might be out of step with the group. And I suppose there's just to keep in mind to try and be prepared to explain why it's not transfer pricing that is driving that particular outcome. So it's something that just goes a bit beyond a pure sort of methodical approach. It's, you're ultimately managing tax risk here. And just keep in mind that it's, tax authorities are quite sophisticated these days. And so, having a story to tell and story you can stick to is something that's very useful in your transfer pricing documentation.
Yeah, couldn't agree more, Paul, particularly around, making sure, wider economic circumstances and things like that, bringing that into the story, like you said. A lot of people say that transfer pricing is an art and not a science. So it's all about painting the picture, as it were. Just very quickly touching on the other 2 results. So lack of internal data, it's not a requirement. There are, a number of OECD accepted transfer pricing methodologies that can be applied that don't require, internal comparables, as it were. And in terms of regional comparables, the region is kind of notorious for lack of maybe transparency or compliance and availability of comparable data. However, in practice, as we'll get onto a little bit later, there is kind of established practice in the region for kind of expanding the geographic scope to go beyond like the specific Middle East region. I guess then just moving on to the last question, whether anyone has been subject to audit in the Gulf or the MENA region. So again, a bit of a mixed bag. 57% have said not yet. Then, you know, the next was 22%, not yet, but some information had been requested. And then 14% yes with concluded, and another 7% saying yes, and that the audit is ongoing. And I guess just in that, you know, as we kind of spoke about previously in terms of the approach that the FTA might take, it is a little bit wait and see, but I guess the comments that we made earlier probably still hold true for anyone awaiting audit. Just to say as well, in terms of timelines, it will likely be, you know, that kind of September 25 and onwards when the audits will really kick off. So then I guess just moving into the UAE TP legislation. So as Thomas said, the purpose of this is not to kind of painstakingly go through every detail of the transfer pricing legislation. However, of course, it would be remiss not to discuss it at all. So we will briefly go through the kind of core provisions. So really chapter 10 of the decree law goes over the transfer pricing requirements, articles 34 to 36 in relation to the arm's length principle, control and related parties, connected persons. And then Article 55 is in relation to the TP documentation requirements. And really, those ones we're going to discuss in a couple of slides further down the road. I just wanted to maybe highlight some other relevant areas that might be worth considering from a transfer pricing perspective. The first one on the board is the $1 million question, Article 18, free zone persons. I think a lot of the uncertainty around Article 18 and the application of CIT to free zone persons is really around the pending cabinet decision on qualifying versus non-qualifying income. However, from a transfer pricing perspective, I guess there is a little bit more certainty there, right? In terms of the requirements to be a qualifying free zone person, means that related party transactions must be conducted on arm's length basis. So the arm's length principle does apply to free zone persons. And similarly, they will have TP documentation requirements. Likely that is to ensure that, you know, the FTA have a leg to stand on in the event that there's any transfer pricing disputes, maps involving counterparty jurisdictions, and they want to be able to, as part of the wider, you know, effort of the UAE to really be transparent and show that they are aligning with international best practice. So then the next couple, Articles 26 and 27, transfers with a qualifying group and business restructuring relief. Those really relate to provisions, I guess, where subject to meeting the conditions required, that transfer pricing might not necessarily be applicable. So to the extent that you are a qualifying group, 70% equal shareholding, same financial period, along with a number of other conditions, would mean that any transfers between the qualifying group would be at no gain, no loss. So for that reason, there would be no transfer pricing requirement in terms of the pricing of that transaction, be it, you know, property, intellectual property, inventory, anything of that nature. Similarly, business restructuring relief. So subject to meeting the conditions, if you were to transfer your business, it would be at no gain, no loss. So again, it would be outside the scope of transfer pricing from a UAE perspective. I think that is helpful potentially for a lot of businesses, because there is a specific provision in the OECD transfer pricing guidelines in relation to business restructurings, which I think Paul can attest to can be quite a complex area in terms of whether there are kind of compensatory payments due for the transfer of functions, assets, or indeed risks between different entities. Then really Articles 30 and 31 in relation to interest deductibility. It's to say that going beyond the 30% EBITDA interest limitation rule, there's kind of a prerequisite to that almost, which is that on first principles, the understanding is that any interest on loan arrangements should be conducted at arm's length. And again, there is a separate chapter in the transfer pricing guidelines in relation to financial transactions, chapter 10. So it's critical for any interest arrangements that, you know, the interest is appropriately priced. Typically it's done, there's a lot of third-party market data available through the likes of Moody's, and really it's just important to kind of get that right at the outset as a pre-step before the application of that. Article 31 then has some specific limitations on deductibility for related party loan arrangements. It's in relation to certain transactions, kind of profit distributions, the acquisition of entities that would then become related parties, along with a number of other ones. So really just to be conscious of that when looking to finance those types of transactions, just to ensure that you're not maybe setting up the structure in such a way that you might be losing out on interest deductibility. Article 42 then is taxable income of tax groups, similar to qualifying group and business restructuring relief. There is a slightly higher shareholding threshold, I guess fairly significant one, 95% shareholding, along with a number of other conditions that are required to be satisfied. But in that scenario where you do form a tax group for UAE purposes, it adopts a kind of fiscal unity approach, which is common in a number of jurisdictions. And in that scenario, I guess the group is taxed as a whole. So any intercompany transactions would be eliminated. Again, useful for planning purposes and kind of at the outset of understanding your TP requirements or arrangements, to understand whether this is something that is feasible from your group's perspective, if as it would, you know, lead to a reduction in TP compliance requirements. Article 61 then is in terms of the transitional provisions. So one of the requirements is that the opening balance sheet for the first accounting period is the items are registered at arm's length. So that might be, you know, for any inventory that you hold between related parties, any assets, things of that nature, and indeed with loans as well. So one of the key things is in relation to receivable balances. If you have outstanding receivables for a long time, and there's no interest being charged on those, even though they might be, you know, just kind of standard working capital or, you know, outstanding invoices and things of that nature, to the extent that they go on beyond maybe reasonable commercial terms or the intercompany contract, if that's available, or contracts with other non-related parties, then you may need to consider whether it takes the form of a loan for transfer pricing purposes. And in that scenario, you may have to apply some kind of interest on that, or the FTA may seek that. So that might be something just in terms of good practice going forward, in terms of making sure that the payments are done in a timely manner. And I guess just a couple of honorable mentions before I leave. So before I leave this slide. So extractive and non-extractive businesses, as well as government and government controlled entities, each have kind of broadly similar provisions. Each of those types of entities would be exempt from corporate income tax in the UAE. However, to the extent that they have non-exempt business activities, non-mandated activities, etc., there is a specific reference to any transactions between the non-exempt portion of the business and the exempt portion of the business. Any transactions between those should be conducted on an arm's length basis. So again, just to be conscious of that and to keep it in mind.
So, as Liam was saying earlier, we're not going to go through, you know, every single aspect of the transfer pricing legislation in UAE, but just to call out some notable mentions here. So, I mean, the first thing is, you know, the FTA has spent a lot of time in consulting with other tax authorities globally in trying to make sure that you have got an extremely good fit for purpose transfer pricing regime from day one. And it's great to see that, you know, the basis for this is the OECD guidelines. So these are, you know, almost the global transfer pricing rule book. It's, you know, it's widely adopted by most jurisdictions globally for determining arm's length pricing. And it runs to hundreds of pages and it's consistently updated. Now, it doesn't necessarily mean it will give you the one right answer if you read the transfer pricing guidelines, but it will tell you the factors that you need to take into account and the process you need to adopt in order to arrive at an arm's length outcome. So, I mean, the requirement here to meet the arm's length principle aligns with, UAE's commitment to transparency and alignment with international best practices. Some global tax authorities apply the legislation to domestic transactions, and we have this in UAE as well. So, free zone entities, for example, that only transact domestically, they would still be required to meet this obligation that typically applies to international transactions most of the time. In terms of what the practical application looks like, we've got here, use of the arm's length range. Now that can be interpreted in a number of different ways, depending on which tax authority you're talking about. In this case, the arm's length range, we believe, consists of the full range. So if you have a result anywhere in that range, then arguably you can support that as being arm's length. We're using all of the OECD prescribed methodologies, which is fantastic. There is information there to confirm that if there is an adjustment, so a corresponding adjustment. So, for example, if you have a unilateral adjustment by a foreign tax authority relating to a transaction that impacts UAE, the FTA has confirmed that they will accept a corresponding adjustment to avoid double taxation. I mean, there are steps involved in order to get there, but as a concept, that's very good to see. And the other notable one here is around advanced pricing agreements. Now, this is something that you often see get implemented years after transfer pricing has, or the legislation has got up and running. But here it's something that the FTA has noted from day one. And what we mean by an advanced pricing agreement or an APA is it's just a contract between tax authorities. So sometimes just the tax authority and you as a taxpayer, or it can be between two tax authorities regarding how the pricing of certain transactions are going to be taxed over typically a 3, 4, or 5 year period. So a lot of taxpayers use this where they have got complex or high value or controversial transactions that they want to have some certainty upfront for a period of time. They enter into agreement like this with the tax authority. And it's great to see that that's something that will be on the table, and taxpayers can avail themselves of that going forward.
Yeah, absolutely. We're just saying advanced pricing agreements. Yeah, you're absolutely right, Paul. It is something that we normally see kind of a little bit further down the line. And that's the best example for that, really, I guess, is the latest updates from the KSA, really, which we might discuss a little bit on the evolution of TP regimes. But part of their kind of most recent updates, they have confirmed that they would be announcing an APA program. And again, exactly correct that it's really only something that is for kind of complex transactions that there's a great deal of uncertainty. I think generally the advice is if you've got a relatively simple transaction, that you no need at all to go down the APA route, as it can be quite costly and time consuming and all that good stuff. So yeah, I guess going into a little bit more detail now in terms of some of the aspects of Chapter 10 of the Federal Decree Law, as I mentioned. So the scope, there is quite a wide scope in terms of we have related parties as well as connected persons, and to stop some tax arbitrage that might take place in the event that, given the absence of personal income tax, I suppose here, that there is the opportunity for that here. Paul, do you mind taking over 1 second?
Sure. So just in relation to the TP legislation, related parties, what does that really mean? There are some guidelines around that. Connected persons, I think there is quite a broad view of what can be considered a connected person in relation to a transaction that would be subject to transfer pricing in UAE. And similarly, around control, there is there's a definition of what can be considered control from a transfer pricing standpoint. And you can see here that, you know, it's not necessarily just ownership. You know, it can be 50% or more of voting rights. If you have 50% more, you know, constitute 50% more on the board of directors, for example, or around profits, which I haven't seen before, that can be classified as being controlled from a transfer pricing point of view, and therefore that transaction can be considered in scope and something you'd need to support from a UAE perspective.
Exactly. Yeah. Apologies. My screen went blank there for a second, so I'd lost my control for a little bit. But yeah, let's get back to it. So as you rightly said, you know, in terms of control, they've got quite prescriptive approach, as well as the kind of overarching exercise of significant influence, which if we again look at the KSA example, as a jurisdiction that does have very prescriptive approach to control, they would look at things such as like funding, or are you the sole or primary person that conducts business with this entity. So even though you might not have the shareholding percentage, but if you you know, 90% of your economic transactions are with this entity, then there is a chance that there could be control. So if we then move on to the transfer pricing methodologies, so again, we're going to take a very broad brush approach to this, but you know, as Paul rightly mentioned, it's very good news, I guess, that the TP legislation does reference specifically the OECD transfer pricing methods. So there's 5 of those: the comparable uncontrolled price method, the resale price method, and the cost plus method. They would form your kind of traditional transaction methods. But then additionally, we have the TNMM, the transactional net margin method, and the profit split method, both of which are, well, it's really the TNMM, I guess, that in practice would really be one that is applied more often than not. I think it's fair to say that looks at kind of like determining comparability by looking at the operating margins of companies that perform comparable transactions. So really any of these methods, as we say, are allowable and accepted under the UAE TP legislation, which is great. Additionally, similar to the OECD TP guidelines, there is scope to select any other method on the provision that it produces a better example of an arm's length approach. So again, not going to try and go through all this in detail. Don't want to bore anybody to death, although I'm sure people were laughing when I lost my place there earlier, but except for maybe Paul. But look, really, we've set this out, and obviously the slides will be shared later in terms of the strengths and weaknesses of each of the individual methods. I think the CUP method is typically, you know, one of the stronger methods or the more generally accepted. However, it can be difficult in practice because it does require a very large level of comparability between transactions. Similarly, the RPM and the CPM can be a little bit difficult at times. They look at the gross margin. So in terms of finding a sufficient comparables, the TNMM is often applied, but there are some nuances to that, I guess. And then the profit split method is again in those kind of more complex transactions where it requires kind of a more detailed kind of review of the individual contributions of each entity. However, it can be quite subjective and is often subject to challenge. So as I said, we'll share these slides, so you'll have these to review in a little bit more detail later on.
And Liam, sorry, if we just jump back. Just one thing I was going to add there is just that in a lot of cases, sometimes it can be beneficial to use more than one method in your transfer pricing documentation to support the outcomes of a particular transaction. You know, we all know that you know, tax is paid on net profit, and so yes, you might have a fantastic you know, CUP, a fantastic example third-party transaction that that you believe is the most comparable way to support your pricing, but you'll often see tax authorities focused on the end result, the net profit that's the outcome of all these transactions. And you just need to keep an eye on results and be able to support these by maybe more than one method these days.
Yeah, the corroborative kind of method approach. Yeah, absolutely. Yeah, fully agreed. So then I guess just kind of rounding off the UAE TP legislation, we look at the documentation requirements, and really they've taken a kind of 3-pillar approach. So the disclosure form is going to be something that is due to be filed with the CIT return to outline kind of the different transactions with related parties and connected persons. I think typically we see this in the region. It allows the tax authorities a kind of very easy manner to kind of identify and pick out potential audit candidates, really. And if we look at other jurisdictions in the region, it would kind of give an outline of, you know, the name of the related party, the jurisdiction in which they operate, what type of transaction it is, what's the volume of the transaction, what TP methodology is applied in terms of supporting the arm's length nature of same. So it would be due, as I mentioned, to be filed along with the CIT return 9 months following the year end. The threshold at the moment is to be confirmed, and indeed the format as well. However, as I mentioned, you know, we see it a lot in the region, so there's probably a broad idea at this stage. And then kind of on top of that, we also have the master file and the local file requirements. So the master file, as it says here, you know, it gives a kind of more of a macroeconomic high-level overview of the group. There are specific requirements outlined in the OECD TP guidelines, which will likely be brought in. Really, the local file then kind of goes into a little bit more granular detail of the activities, the specific intercompany transactions of the local entities in the UAE or in the relevant region, would have kind of specific economic analysis, functional analysis of those entities. Those ones will be due 30 days upon request. They have outlined or made reference to a threshold in the legislation. However, that's yet to be kind of confirmed. And then in terms of the format, it will be kind of that OECD format. So there's kind of a pre-established approach, which is always useful.
Yeah, and I suppose this suite of requirements is something that you see typically in the more advanced economies and jurisdictions globally. So tax authorities want to know in a nice, easy, digestible format what transactions you're undertaking with your related parties. And it, as Liam rightly outlines, you know, it can often feed a tax authority's engine in terms of who are they going to review, who are they going to audit, who are they going to select and follow up on. Master file, I would have thought most taxpayers who would be subject to this elsewhere would already have one of those in place. And as we've seen from the poll, it's probably the local file that is the most important aspect to focus on over the next coming months and maybe into next year, and make sure that that accurately reflects your activities undertaken in the UAE. There's probably the most amount of work to do in year one. But after that, it should be sort of a maintained process, assuming things haven't materially changed year after year.
Yeah, fully agreed. So then I guess for the next portion of the webinar, we're going to talk a little bit the evolution of TP regimes, specifically in the GCC. So here we've kind of got a high-level overview of the application in the other GCC countries. And I guess really here we can see that both KSA and Qatar are really kind of the leading examples of jurisdictions that have implemented transfer pricing rules kind of across the board. Relatively recently as well, right? So I think it was 2018 that they both introduced, but they've got kind of this full suite of like TP rules in terms of they've got formal legislation which relates to the arm's length principle, and as well as kind of guidelines that the relevant tax authorities have released, as well as documentation requirements in excess of the kind of CBCR reports, which is a requirement in some of the other jurisdictions. I guess useful or worth noting that while the KSA and Qatar both are broadly largely aligned with the OECD guidelines, there are maybe some subtle nuances in terms of differences in each of the regions, which we hope not to see so much of in the UAE, to be honest. But if we look at the KSA, for example, you know, they've got a specific exclusion of loss-making entities in terms of your benchmarking analysis, which the transfer pricing purist like myself, I'm sure Paul would say that, you know, to a certain extent, like if you're looking at a purely arm's length basis, if they are functionally comparable, whether they're loss-making or not, should be acceptable. But, you know, it also makes sense from their perspective. They want to ensure that they retain as much profit as they can in the KSA. And then other, you know, subtle differences, but again, not major. And similarly in Qatar, you know, they do have a very stated preference for the application of the CUP method. And to the extent that you don't apply the CUP method, then there is a requirement to file an appeal or an application to the Qatari tax authority to outline the reason why you have opted against that method. Now, in practice, we've seen some people take the prudent approach and go through the formal application process, and in other scenarios, we've seen clients just proceed and kind of include the rationale within their kind of transfer pricing documentation. Then when we look at kind of the rest of the guys, they're probably a little bit behind, similar to what the UAE has been up until this point. Both Oman and Kuwait, they do have some kind of element of TP return or disclosure form as part of their CIT returns. They do indeed have corporate income tax regimes in place. So although formally they may not have transfer pricing rules within their legislation, I think from a practical perspective, we do often see that, you know, the tax authorities there are on the lookout for related party transactions. And to the extent that there is any kind of major anomaly, then it's certainly something that they can look to adjust or, you know, seek to change. Kuwait as well has has prescribed kind of related party margins that could be applied to related party transactions. And then Bahrain, we've kind of left as the last one, little engine that could. It doesn't have a whole lot going on at the moment in terms of corporate income tax, etc. But you might see that in the recent developments, we've marked BEPS 2.0. Now, BEPS 2.0 could probably apply to all of the GCC, minus maybe Kuwait, as it's not an inclusive framework signee. And indeed, it could apply to everyone. You know, BEPS 2.0 is a very real thing that's coming down the tracks. I guess we just included it there for Bahrain, as if it intends to meet its obligations and introduce Pillar 2, then, you know, it would probably require the introduction of a corporate tax regime, which along with that would come transfer pricing. So it's a bit of a watch this space. And then the final recent development, I guess, is just the extension of TP rules to Zakat entities, which has come in recently. So I guess we can just move on and just kind of the observations that we see in the region.
Yeah, so I think what we expect to see, and you see this when transfer pricing has been introduced with other tax authorities, not just in the region, but globally, is that the transfer pricing regime evolves over time. And, you know, what you typically see is that there is, you know, a light touch approach from day one. And the reason there's a light touch approach is, you know, there's the tax authorities want to encourage taxpayers to adopt the right approach, adopt the right behavior. They realize that, you know, they may not have provided 100% of the information that's required from day one. But then over time, you start to see, as the tax authorities build up their capacity, as they get more experience, as they get more information from the forms that are provided, they start to challenge, and they typically start with sort of the lower hanging fruit. And what I mean by that are the simpler transactions. So the ones that are easy to potentially challenge. And in a lot of cases, these are service transactions, and maybe losses, those types of things where it's easy for the tax authority, or easier for the tax authority, to understand the background and the reasoning behind all of this. And then over time, as you see these rules progress and time progresses, and as they build the teams, the transfer pricing regime evolves, and you start to get challenges around more complex transactions and things that might be particularly relevant for that jurisdiction. So these might be higher risk transactions, so they might be business restructures, they could be inflows or outflows of intellectual property, it could be losses in particular industries, for example. So as the tax authority and the tax department grow in terms of size and experience, as they build capacity, the volume and the depth and the complexity of the transactions that are under scrutiny also evolves. And if we take sort of Egypt and Saudi Arabia as examples, so in Egypt at the moment, if you have transactions that relate to things like a change in a business model, if you are a consistent loss maker, we know from experience that the Egyptian tax authority is having a close look at those types of transactions. Also, if you are a distribution business, a service business, if you're in manufacturing, again, these are the types of businesses that are on the hit list or higher risk of challenge and review by the Egyptian tax authority. But it's not the same the world over. Saudi Arabia, for example, they're conducting multiple audits, and you see this in a lot of other countries. So they're focusing on taxpayers that have got a high level of or high amounts of related party transactions, and particularly those that are loss making. And how do you how you defend this also depends on how sophisticated the tax authorities are. And what we have seen over time is that there's now a conscious look at not just the operation and the taxable outcome in one jurisdiction, so not just your taxable profit, not just your activities undertaken in UAE, for example, in order to understand if those outcomes are arm's length. Tax authorities want to understand what's on the other side. So they need to understand the full value chain. And only by understanding that can they then put things into context. If you are a relatively simple, low value adding activity in a particular jurisdiction, but the total system profit is extremely large, you can imagine that the tax authority might want to see a greater slice than if that total system profit was relatively small. So these things are very important when it comes to trying to defend your transfer pricing, depending on which country in which you operate. And as time progresses, and what we have seen in tax authorities quite consistently globally is they are now becoming more and more sophisticated. So whereas in years gone past, you might just be asked to provide your transfer pricing documents, there might be some follow-up questions around all of that. Now what we're seeing, given the depth and the quality you have of individuals in the tax authority, and we know that the FTA is actively recruiting, and they have a number of really, really good, high quality individuals that have been involved in managing tax and transfer pricing as advisors and in other tax authorities globally. The types of audits and the types of experiences you're likely to have are extremely sophisticated. And what we mean by that is the type of data you're being requested can be quite complex. The level of information sharing between the local tax authority and other tax authorities has increased exponentially. The understanding from the tax authority can be extremely detailed. They know the business that you operate. You don't necessarily have to explain to them exactly what your industry does. They probably know that now. And there's this big focus on show, don't tell. So, yes, you might have a story, but you need to be able to back this up with evidence that this is what's actually occurring. So if you are picked up for challenge, there's probably a very good reason why that's the case, and you need to be in a position to defend this. And just the last thing here is we know, at the moment, and we have seen that the FTA is actively recruiting. So you can expect quite a well-staffed and a well-educated transfer pricing task force within the FTA from day one.
Yeah, couldn't agree more, Paul. I guess just in the interest of time, we'll kind of jump into the key points here, the implementation and preparation, and really the steps that can be done at this stage in order to, really get everything right from the outset, because I think that's a really important thing, right? Particularly if we look at things like audit triggers and stuff like that. If there's key changes in stuff like the operating model and indeed the total amount of or allocation of profits to the UAE from one year to the next, there's big shifts that can often be an issue. So really it's about getting it right at the outset, and it's kind of how do we achieve that, right? So I think one of the key things is understanding the TP cycle, kind of understanding the start to finish, as well as, all the various things that go along with that, so that you can get the appropriate preparation in place. We'll discuss that in the next slide. Also to kind of the functional assets and risks, to kind of get a good understanding really of what entity performs what where. And it's really, that's one of the key drivers, I guess, of where the allocation of profit should be. So profit generally should be aligned with the activity, the economic activity, the high value adding activities, right? And then just another couple of quick points that we mentioned on this slide is in relation to DEMPI. So that's something that's come out in the last number of years with the 2017 OECD guidelines, particularly for IP transactions. So to the extent that the UAE has like a significant R&D function, if there's kind of a chief technology officer or a VP of sales or something like that are performing some of these DEMPI functions, the development, enhancement, maintenance, protection, and exploitation of intellectual property, then it's just something to be conscious of when kind of determining what the appropriate allocation of profits should be. And then, of course, for anything, it's about, like you said at the outset, Paul, just, getting the appropriate methodology to support it, right? It's not just about having the arm's length price in place. It's also being able to show your work, show your markings, and support it, really. Yeah. So then if we move on into kind of what is the transfer pricing cycle. So I guess we kind of set it off here, and there's kind of a bit of a recurring process that happens in the middle, but really I guess the key point is around the planning and policies. And what should happen at this stage really should really be things such as your functional analysis, like we mentioned. So everything is kind of predicated off that. If you think about it, and if you jump ahead to price setting and your contracts and, updating your ERP system for the transactions and journal entries. But then when you go to testing and compliance, that's when you perform your functional analysis and your benchmarking analysis. Then you find out that the profit margins that are being left in the UAE are not aligned at all with the activities that they perform, that's when you got a bit of a problem, right? So you've kind of reversed the roles. So really the planning and policies is very key from the outset to kind of understand that your approach to documentation, how you want to do it. Is it possible to group entities as well, like we spoke about earlier, because that would eliminate some of the transfer pricing requirements. And indeed, if there's any acquisitions or integrations, they might have other transfer pricing operating models in place. And then it's a case of, well, how do you kind of align those? And then looking at the kind of more recurring process, once you've got your policies in place, it's around setting your price, getting intercompany agreements in place, although that's not a requirement. It can often be like a first line of defense. Transfer pricing generally looks beyond the contractual form, but still it is kind of a good starting point, particularly in the event of audits. Transactions and journal entries, that's getting your ERP systems in place and things of that nature. Monitoring and adjustments do have to take place sometimes, in terms of that, the recommendation is often to do it on a quite a cyclical basis, like quarterly or perhaps half yearly, rather than saving all your adjustments at the end, which could distort things in other aspects from a tax perspective, such as like, your customs valuations and things of that nature. And then your testing and compliance is really just wrapping all that into kind of your documentation and local file and forms like that. Separately, controversy and litigation is it's about having a process in place that to the extent there is an audit, how quickly can you access the information that's required? Do you have kind of pre-prepped position papers in place and things of that nature for kind of uncertain tax positions? So that's just a broad overview, I guess, of the transfer pricing life cycle. Then, I guess very quickly, just going over this, there's a lot of different operating models, and this is again in your planning and policies. What operating model you operate will dictate to a certain extent kind of the policy that's applied. If this geographic hub model where you've got a regional headquarters in the UAE that performs a lot of entrepreneurial functions, well, you would expect that the profit allocated to that entity would be higher than if it's a centralized business model and the headquarters is elsewhere and the UAE is performing limited risk functions, then indeed, the expected profitability would lower. Paul, I don't know, do you have anything to add here, or will we move on?
I think in the interest of time, we should.
Yeah, absolutely.
So, yeah, just in terms of the transfer pricing function, and this doesn't necessarily have to happen within, the tax group. What does this really mean? Well, in terms of people, it just means educating the important people, the stakeholders that you have that will be involved in the overall process. So that often means business, finance, legal, operations, the people that are going to be involved in some shape or form in your transfer pricing throughout the year. Process, well, that's just making sure that you have an understanding of who and what gets what the process is in relation to booking intercompany transactions. So there's no point just devising the right pricing. You need to make sure this is booked on some form of regular basis, be it monthly, quarterly, annually. Data, we shouldn't overlook the importance of data, particularly in the current era. Rubbish in, rubbish out, all of that applies here. Tax authorities are extremely they're laser focused on making sure that that this all makes sense. So there's no point having a simple policy that says cost plus 10 if you're not applying the 10 to the right cost base or a consistent cost base, for example. And then the last piece here is just around governance, and that's making sure that those people involved in the process understand what their role is and when they need to perform it. And it just makes sure that you keep this alive. So great if you spend all this effort on day one to get it in place, but you need to make sure it's a living, breathing aspect of how you do business going forward.
Yeah, agreed. So then I guess in terms of preparation, right? So what can be done now? As Thomas mentioned at the outset, 6 weeks away from the introduction of CIT rules. So some of the key things, I guess, is transaction mapping. So, right, that's getting a full assessment or understanding of what exactly are the actual intercompany transactions that take place within the group, because that's your starting point, right? That's your basis. First, you have to identify the transactions, and then you go about pricing the arrangement. Ensuring consistency with the global business, I guess that's really in terms of where you're part of a larger multinational group, to ensure that, you know, any TP policy that's taken or any methodology that's applied here is broadly aligned with the rest of the group. You don't want to be doing something completely ad hoc, because that might raise questions in any kind of wider audits, or if there's audits in other jurisdictions, with the UAE as the counterparty. The functional analysis, you know, we mentioned before, it's really critical to get an understanding of what kind of functions are performed in the UAE in order to understand what the appropriate allocation of profits are. The comparability and economic analysis really is your benchmarking, to actually, once you've identified the transactions, you understand the functional activities, then you go about kind of proving out the arm's length nature of the transactions. Considering wider tax implications, I think that's really important as well. So it's not, there may be situations, right, where you could have a transaction that with the KSA, for example, which has an extensive withholding tax regime, and if you could structure it in such a way that it might be subject to, say, a 5% withholding tax rather than 20%, you know, or potentially, like, you know, customs valuations issues. It's good not to look at transfer pricing in a box, basically. You know, it really encompasses the entire business, because you have to look at all, like, what everyone is doing within the business, right? And then that shouldn't exclude tax as well. You should get an understanding of you know, the wider tax implications of your TP policy. Educating the key stakeholders, I think Paul touched on that before. And then, you know, indeed as well, in terms of the intercompany agreements, governance model, TP framework, etc. And then there's also the ERP system assessment, the testing, just making sure that, you know, once you've got your pricing policy in place and set, it's just that you can actually, you know, functionally or practically apply it. And then going through implementation, I guess it's just, you know, once we have implemented something, once there is a policy in place, it's just what is the process for assessing the adjustments. As I mentioned, it's better to do a kind of monthly, quarterly, half yearly, rather than just saving it all to the end and having a massive swing in profits that could, you know, affect bonuses, things of that nature as well. So it's always just important to be mindful of it and just having an idea of what the target operating margin is. And again, in terms of educating stakeholders, that's something that everybody should really have some kind of understanding of, right? Consistent review at the outset, just to ensure that everything is functioning operationally. Collation of information for compliance, that would kind of fall under the transfer pricing life cycle in terms of testing and compliance, or potentially maybe in a controversy setting. Adherence with governance, as we kind of touched on before, it's all well and good to have a bright and shiny TP policy in place, but if you're not actually applying it in practice, then it could raise issues down the line in the event of an audit or something of that nature. And then getting your documentation in place, so getting the strategy, you know, using third-party service providers, or do you have something internal that you can use? Is there existing documentation that can be leveraged based on the wider group activities and things of that nature? So then FAQs, we can, I'm not sure how we're doing on time. Should we just run through these?
I think maybe if we do these very quickly, Liam. So one of the first things here is just, you know, are you able to leverage a local file from another jurisdiction?
Yeah, so I think, as I mentioned before, you know, there are certain elements that might be leverageable, but like really, as we've kind of talked throughout the entire discussion today, is that, you know, tax authorities do look for, you know, specific information relevant to the jurisdiction in place. So I guess the kind of carbon copy and paste dump approach would not really be applicable in this scenario. So really it should be, and as mentioned before, like the local file goes into granular detail of the specific transactions of the related party. So indeed, in terms of, you know, comparables and things of that nature for benchmarking, you wouldn't be able to rely on US comparables. You should look at something in the region or the wider geographic scope.
So no, not really.
No, not really. Yeah.
Yeah. In terms of benchmarking, you know, what's the likely approach of UAE here?
Yeah, so as we've said from the outset, they seem to be approaching or adopting a fairly standardized OECD type of approach. So we've got the TP methods that are approved. And then, in terms of regional comparables, again, we've touched on that a little bit before, that there is certain difficulty in identifying regional comparables. So there should be scope to kind of expand that geographic scope when performing a benchmarking analysis.
So start off with UAE, expand to Middle East, and maybe beyond if you're struggling to find a right number of comparables.
Absolutely.
If you're using that.
Yeah,
Okay.
I think that's what we find often, that, just be able to show that you've tried in the first instance.
Yeah, there's almost a hierarchy. Yeah. Okay. In terms of high risk transactions, are there any transactions that people should really pay, a lot of attention to or prioritize in UAE?
Yeah, so I think just again, very quickly going through this, that, there are the IP transactions are always kind of fraught with controversy and subjectivity. Additionally, kind of financing arrangements, I think in recent surveys, we found that can be quite contentious in some jurisdictions. Services transactions compared to goods can often be a little bit tricky in that there's, just ensuring that there is sufficient benefit that you would be willing to pay for that transaction at arm's length. So that would be kind of the key kind of high risk transactions. Okay.
And would people be able to do all of this themselves?
I don't want to, doubt the abilities of anybody on this attending this. So absolutely, I'm sure, they could, but it's always helpful to have a second pair of eyes, an advisor to kind of assist. And in that regard, that's something that we've got a lot of experience with here. So although, it's something that certainly there's need for buy-in locally, right? Given the pervasive nature of TP, it's inevitable that there'll need to be understanding within the organization. But again, in terms of assistance with documentation, etc., it's always helpful to have a second pair of eyes.
Yeah, I concur with that. And then I suppose, there'll be a lot of effort undertaken in trying to get this right in year one. Is that it? Can we then walk away from this whole thing and never have to worry about transfer pricing again?
I wish I could say that is the case, but unfortunately not. Like you did mention, to the extent that there's no major changes to the facts and circumstances, it can be a bit of a roll forward approach. However, you would need to update the financial results of benchmarking kind of annually to ensure that you're still following the most up-to-date pricing of the comparables that you've identified and things of that nature. And again, checking in with the business constantly just to make sure that, there hasn't been any substantial shift in the functions or activities. So again, no, not really, I guess.
I'm just conscious of time, Liam. I think we probably should move on to sort of next steps and what people can do around all of this.
Absolutely.
So, if nothing else, right? If you've gone away, made yourself a coffee, and come back, and you need 5 minutes to understand exactly what you do. Well, if you're starting out on this journey, the first thing you need to do, and refer back to the transfer pricing life cycle, is so understand what your transactions are. So this is base information. So what are the value of your related party transactions? Which are the counterparties that you are interacting with? What are the legal entities? Is there a policy in place for setting the pricing associated with those transactions? And what support is there at the moment in terms of being able to justify the pricing associated with those? Is there existing documentation elsewhere globally? Are there legal agreements in place? Is there a spreadsheet? Is there something else to support the transactions? And this is critical, because this is base information that you need to understand in order to shape your transfer pricing going forward. Armed with that information, you can then make an assessment, maybe with the assistance of advisors, around whether or not there are any particular areas to address, or any gaps. Then you might have 5, 6, 7, multiple number of transactions, and some of them might well be well supported. Some of them, because of the history of transfer pricing in UAE, they may have been glossed over, not important, or not important enough to apply normal policies to and documentation. And so they may be the ones that you need to spend a bit of time and attention on. So once you've got your base information, there's then a matter of determining, which transactions to prioritize and focus on. That will involve coordinating with the wider team, either regionally or globally. There'll often be some others that have an interest and stakeholders in tax and transfer pricing. So you're not going to be starting from a zero base in most cases. And because we're talking about year one, there may well be situations where, having looked at these transactions, you need to address some risks. And these might be historic risks. So there might be, let's say, for example, a whole bunch of costs that have been allocated to UAE for whatever reason may be the case, that haven't been closely looked at in years gone past, and because there was little risk associated with it. Now, on closer inspection, you may have to deal with those in a bit more detail, determine what you think is an appropriate amount to reside in UAE, and you may need to change things elsewhere. That is something that you'll probably need to address at some point. And then, we're talking about putting together transfer pricing documentation. It's likely that a master file will exist. So, from year one, it's the local file for UAE that will take precedence. And you'll need to put in place a process in terms of trying to pull that together again, at least in year one. Often that involves the assistance of advisors to help shape this and make sure that you're saying the right things and it's the right level of detail, et cetera, et cetera. Intercompany agreements are something that's considered very good business practice. So this is just an agreement, a legal agreement between counterparty A, counterparty B, formally documenting your transfer pricing arrangement. And a lot of tax authorities do look at these in more detail when you're audited, and the US is one of those that pay particular attention to the legal form. And the last point here is just around ensuring there's a proper governance framework in place in order to review this on an ongoing basis. So no point spending all this time and effort in year one. You need to make sure that is then kept live and continues to be appropriate year after year. So it might sound a bit daunting at first, but just that there are some simple steps that that people can follow to help them along this process to implementing transfer pricing within UAE.
Fully agreed. Fully agreed. I know we've gone a little bit over time, so I think we will maybe answer one or two of the questions that have come through, just not to leave people waiting. And of course, we can respond as well after the fact to the relevant people. So I guess the first one that came through was from Neil Wadwani. So the question was, are we expecting any safe harbor rules to kick in as well? What's your thoughts looking at the GCC region regulation? So in terms of the safe harbor rules, kind of the low value intergroup services, I think from my perspective seems to make sense. I think it's one that is kind of widely adopted in OECD jurisdictions. That is where if you meet the kind of low value definition as defined in the OECD, that you would be able to include a 5% markup without any requirement for benchmarking and things of that nature. However, I think generally speaking, we don't see too many safe harbors in the GCC region. So
Just picking another one up here from Dan Lorenz Dugo. Between the two related parties, who is the one required to maintain the TP documentation, the seller or the buyer? And the simple answer to that one is both. So if you both are caught by the transfer pricing legislation, so both considered within scope from a UAE perspective, then both will need to include those transactions. Obviously, it'll be the flip side of the transaction. One might be buying, the other one will be selling, but both would need to include it in their transfer pricing documentation.
Yeah, agreed. Just picking out another one. One was with respect to what are our thoughts on the application of TP rules on salaries bonuses for connected persons like director or officer. And what is the best way to confirm the basis of the arm's length on salaries? I think unfortunately what it means is that kind of directors or owners of the business won't be able to pay exorbitant bonuses to themselves and things of that nature. So in terms of the best way to price it from an arm's length perspective, you know, you could make reference to kind of public company and public information in terms of what the kind of salaries are of the kind of high level directors, etc. That would depend somewhat on, you know, the level of the business itself. You know, if it's a small regional company and you can't really compare it to the director's salaries of Apple necessarily. Other than that, I think you could try and just make a basis, perhaps looking at historical, like this is what we've always paid these people. This is, you know, to the extent that they've been directors or officers of the company for a long period of time, you could almost use that kind of look back approach to say, look, the bonus is consistent to what it has been for years, and this is how we retain the key staff needed in order to continue to, you know, operate on and you know, exceed. And
just having a look at some other ones here. There's one here from Stephen Castillo, Liam, and you might be best placed to answer this, around what kind of substance is required in UAE to be considered a tax resident entity.
So tax residency, I guess the first port of call is place of incorporation. So if you're incorporated in the UAE under the residency rules, that you would be considered a tax resident. However, there is also the effective management and control has been something that's been introduced. And I think, you know, it's likely to be aligned with most jurisdictions. It'll be a case of looking at the frequency of board of directors meetings. Does it take place in the UAE? What kind of decisions are made within those meetings? I think those would be the kind of the key kind of substance requirements if in fact you're non-incorporated in the UAE, but you would like to be considered kind of tax resident there.
Okay. Maybe we have time for one more. I'm just looking at Patrick's question here, saying, if audited and proven by the FTA that a taxable person failed to comply with the TP rules, how will the FTA determine the correct taxable income without applying themselves the TP rules? And I suppose, you know, this is the whole grey area that we either love or loathe in the world of transfer pricing. So, you know, the rules are OECD transfer pricing guidelines. It's just that they're interpreted by different tax authorities in different ways. And so you as a taxpayer can follow the transfer pricing guidelines and determine pricing and an outcome and have documentation supporting pricing of a certain amount. And under review, you can have the FTA and they can disagree. Mm-hmm. Now, if they disagree, then presumably it's after some form of review or audit. You know, then you're in the world of transfer pricing scrutiny, because you know, this is where things, and we don't know how this is going to shape out in UAE, but that's where transfer pricing disputes occur. This is where in the rest of the world, this is an extremely hot topic. Transfer pricing is probably the #1 tax risk for most multinationals globally. just because you know, there is a grey area. There's a range of outcomes that can be supported as being arm's length. So even though you've gone through all of this effort and you've produced something that you think is justifiable, you know, the tax authority can disagree, and then you're into the world of dispute.
Yeah, agreed. I think just a couple of points on that as well would be that in the first instance, so I think there is a reference in the UAE TP legislation or the CIT legislation related to TP that the tax authority has outlined that it would present its, like, it will make all necessary information relevant available to the taxpayer. So in that regard, you know, I think unlike maybe some other countries in the region, there may not be kind of just no, this is the result. It shouldn't be a 3% operating margin, it should be 5%. And why? We're not telling you, you know what I mean? So I think they have kind of indicated that there will be quite open dialogue, which is really great to see. And again, it goes back to the kind of the overall point that the UAE has always set out shop here as that it really wants to continue to be a hub for business and business friendly approach. So we would hope that that would not lead to those kind of situations, and that there would be that kind of open dialogue and open space to where they would clearly show the reasons why they have disagreed with the approach taken in the relevant analysis. So I think we'll probably call it there. Apologies, we haven't been able to get through to all of the questions. As you can tell, myself and Paul like to talk about transfer pricing a lot, and maybe timekeeping isn't our strong suit, but really, really appreciate everybody who's stuck on the line. And I don't know if Thomas has any closing comments.
Sure. Thank you very much, Liam and Paul, for being with us today and for presenting today, which was also for me quite interesting to hear some of these aspects as a non-TP person. So thank you to everybody for attending. As mentioned, we will be recording, we will be posting this recording on our YouTube channel as well. Feel free to get in touch with Liam or myself if you have any questions around transfer pricing. To Paul, obviously, you know, if you need help with benchmarking, if you need a database for the purposes of benchmarking. So I'd like to thank Paul and Moody's for partnering with us on this, and to both Liam and Paul for speaking today. And we'll be closing off. And thank you again for everybody for taking the time to attend. Wishing you all a very good end of the day.